So Broadcom just had a great day. They're up 4.62% on the 9th of March, and they are a company that had a very good earnings call. They beat on EPS, they beat on revenue, and their quarterly financials are really good. They're up 29.47% year to year for this quarter. Their net income is up 33.55%, diluted EPS up 31.58%, and net profit margin is up 3.17%. So green across the board, in other words, and they usually beat on EPS and revenue as well over the past year. Now, they had kind of a rough 3 months. They were actually down 13.98% over the past 3 months. But otherwise, if you look at them over the past year, up 87%. Over the past 5 years, up 666%. Then, return-wise, they've been pretty solid. Over the past 6 months, they are up only 2.7%. But again, that's because they had a rough stretch over the past quarter until their latest earnings call. Now, if you compare that to the S&P 500, which is up 0.87% today, up 4% in the past 6 months, so not that much better, up 21% in the past year, and up 72% over the past 5 years. So longer term, it has outperformed the S&P 500 over the past 5 years and over the past year. They're having some major AI-related demand here, and their revenue hit $19.3 billion. Again, we went over the year-over-year increase that they just had. And they have a strategic partnership with OpenAI for custom AI accelerators and a massive $10 billion 3-year, 462% plus return on investment. So whether or not OpenAI figures it out and starts becoming more profitable, either way, it looks like Broadcom is making a lot of money off of them right now. They also think that their chip revenue is going to top $100 billion in 2027. So they seem to be one of the AI companies that's actually seeing the profits already. So I already touched on this a little bit, but if you're not completely aware of what Broadcom does, I know a lot of these AI companies, you probably get them mixed up a little bit about who does what. So they have a wide range of semiconductor and infrastructure software solutions, chip design for data centers, networking, broadband, wireless, other markets as well. So they are a big part of the AI infrastructure. As you can see, OpenAI's reliance on them already. Now, they do actually offer a dividend. It's not quite even 1%, but 0.75% is better than nothing. PE ratio is pretty high, but a lot of AI and tech companies have high PE ratios right now. The thing is, some of them are really getting massive returns, so you might be okay with that. As far as some of their financials, we already went over their year-over-year changes. If you look at their assets versus liabilities, they have a decent ratio here, almost a 2-to-1 ratio. You have return on assets and return on capital look really good. It's really strong on both ends there, both in the double digits, which is nice to see. Hedge funds have actually been building up their shares over the past few quarters, and that was before this big Q1 as well. So in Q4, Q3, and Q2 of 2025, hedge funds were actually hoarding shares for the most part. Wall Street analysts seem to have a really positive view of Broadcom as well. They have a 96.3% buy score. 54 ratings is a pretty solid sample size as well as far as how many Wall Street analysts you have. Only 3.7 give it a hold score and a 0% give it a sell score. So that's really nice to see as well. They actually have a pretty nice PEG ratio. I've seen a lot of zeros lately, but they have a 0.77. So 0.77 is usually really good. It usually means that they have almost a bargain for their price compared to their earnings and their growth for their earnings over time. So that's why this is a little different than the PE ratio that most people refer to, is because this one also factors in growth. And usually you want it to be around 1 or 2 and hopefully less than 2 if possible. And that usually means it's not overpriced and that the growth should continue to give a nice return for the stock. Not a guarantee, of course, but definitely a strong number for them. Now, their EV to EBITDA ratio is a 45.23. They do rank worse than 70.98% of 727 companies in the semiconductor industry. But I wouldn't usually say that's like a huge factor considering how big their returns are. Now, if they were more of like a dividend-based company that doesn't have a lot of growth, then maybe I'd be a little more concerned about that. As far as leadership, there's no real number that says for sure how good your leadership is. The best we can go on is what the people who actually work at the company are saying. They give them a 3.3 out of 5-star rating as far as the average score for working here. About half of employees at Broadcom would recommend working here to a friend. And as far as the CEO rating, about 59% approve of the CEO. So a little over half approve of the CEO, who's of course the leader of the company. I would like to see these numbers be a little bit higher. They're not really like in ideal range, but they're not like, I wouldn't say a huge red flag either. So if you were trying to figure out a reason to sell, I think the argument to sell would be, well, maybe the leadership could have better scores. Maybe their employees don't really like working there. They don't believe in the management, which is one of the things that employees kind of pointed to here, is their senior management has low scores. But that's a pretty minor factor. I don't think a lot of people are going to make or break their decision on a stock based on just that. Obviously, the past 3 months could have been better return-wise. They underperformed the S&P 500 over the last 3 months. But outside of that, really, there's not a lot here that would make you look like this is a sell. If you were trying to convince yourself to hold Broadcom stock, then you already have it. Why would you sell it? You just had a 4.62% return today. Now, obviously, a lot of stocks went up today because of the recent news about oil and the Iran war possibly being over or not started, depending on what you define as war. Up the past 5 days, up 10.62%. That's really good. So they may be on the early trend of turning it around and having another spike in their stock over time. Obviously, it's not like they're really turning anything around because they were already doing really well over the past year and over the past 5 years. So they are just continuing a strong start. This might have just been a temporary dip over the last few months. If that was the case, then you could really convince yourself that this is a good buy, because you're looking at, they're not at all-time high, so you don't necessarily have to worry about that right now. If you went back to all-time high, you would have a pretty significant return. And then if you're looking at what they do, they're already boosting their financials significantly based off of a trend that we know is going to continue with the AI infrastructure. So they're a major player in the biggest trend in the world right now in tech, and we're still pretty early into that trend. There's no telling how much more this could grow. It's just a matter of which of these companies is actually financially profiting from this now and not just building their stock on hopes and dreams that this will eventually pay off. There are a lot of AI-related stocks that scare me because they're not profitable and it's all just significant hype and you're not really sure where it's going to go. It's all just kind of like a pie in the sky. This could take off, but it could also crash. Broadcom doesn't seem like that. Broadcom seems like they really know what they're doing. Their financials back that up. Them constantly beating on EPS and revenue is a good sign. Yeah, their PE ratio is high. Their EV to EBITDA ratio could be considered high, but they are, if you factor in growth like a PEG ratio, for instance, there are signs that maybe it would still be worth that price, even though it seems like you might be paying a premium. Some companies, it doesn't matter. If you were so worried about PE ratios, you would have missed out on a lot of returns from Nvidia, for instance. Now, obviously, I can't tell you what to do with your money. You should do your own research, and please do not take anything in this video as financial advice. This is just me breaking down the stock and making an argument for the 3 different positions you could take here, as far as like buy, hold, sell, not obviously factoring in like shorting it or something like that. But from a longer term perspective, for a multi-year perspective, which is what I focus on, I think it could be a buy. I think it's easy to sell yourself on that idea. Everything looks good. The financials, the returns, everything lines up. What the company does, their contracts, everything really lines up. I mean, I could see a few things that would be a little bit better, like again, like their leadership scores from their employees could be a little bit better and things like that. But that by itself, I don't think turns this from a buy to a hold or from a buy to a sell. Let me know what you think in the comments. None of this is financial advice. Please do your own research. Everybody's portfolio and allocation is different, and I'll see you in the next video.